Hello and welcome to Smartkarma's Webinar Wednesday. I'm Michael Tegos. Today I'm thrilled to be joined by Mio Kato, who will take us through his 10-bagger call on Mercari, Japan's successful e-commerce startup. Mio is the founder of Lightstream Research. He has over 15 years of experience analyzing Japanese and Asian stocks, focusing on cyclically driven sectors such as gaming, factory automation, automobiles, and tech. As always, some housekeeping before we start. You are very welcome to send questions for Mio using the Q&A button. Please do not reshare or reproduce the contents of this webinar without express permission. We will have a recording of the webinar available on the registration page afterwards. Mio, thank you very much for being with us today. Feel free to take it away. Today's discussion will be audio only, but I'm sure you can paint a great picture for us.
Thanks, Michael. So yeah, actually, when I was asked to do the webinar, I was initially thinking of doing the usual slides and taking people through some numbers and charts and things like that. But after thinking about it for a while, I think, firstly, we have quite a few insights detailing a lot of the thesis, but I think what's really key to understanding Mercari and the potential value on offer here is to actually understand the conceptual side. And I think, to me, what can actually take this up 10 times is essentially the strength of the barriers to entry on the C2C side, which I think are underappreciated and which can truly be disruptive. You know, a lot of companies brand themselves as the next Amazon, whereas Mercari thankfully doesn't really. But I don't think it's impossible for the company to actually even disrupt the likes of a giant like Amazon. And the reasons for that are what I really wanted to dive into on this webinar. So just to give clients a little bit of a background, we've been covering Mercari since it IPO'd. And initially, when it IPO'd, there was a lot of interest surrounding the stock. So when we looked at the company, we saw certain flaws, particularly on the US business. The Japanese business actually looked pretty nice, but I think when they were listing, the valuation that it debuted at was something like 7 times EV to sales. So before it listed, we actually said, you know, this will probably do really well just based on hype and interest and things like that, but that we had significant concerns on the US, and also we felt that the valuation was quite stretched. So we essentially, you know, suggested it was worth participating in the IPO, but actually on the day of listing, you know, it popped, I think, something like 100%, and we basically had another insight out saying, you know, it's probably worth selling there. And that actually turned out to be correct. And we remained negative on it for a while, partly because we felt that the US business was not going to be successful based on experience with a lot of Japanese companies, particularly on the software and services side, where, you know, ventures overseas tend to end up being disasters. And my experience at Userbase, which is another sort of Japanese SaaS company trying to venture overseas, kind of informed that, in the sense that not just at Userbase, but other similar companies where, you know, I had the opportunity to speak to management and things like that. The problem is often that they try to do things the same way overseas as in Japan, and that usually ends up being a disaster. And it's not even that they don't understand this, but oftentimes they seem to lack the comfort to kind of change their ways and adapt. And there were a few signs that Mercari was adopting the same approach. But they did actually bring in a overseas team and leadership, which some other Japanese companies have done, but oftentimes more in form than in substance. So initially I was a little bit skeptical about that attempt, even with Mercari. But I met with the company a few times, and after conversing with them and really understanding the business, essentially they had set up the US business almost in an internal VC type format where the overseas leader essentially was given free rein to bring in their own leadership and management team. And while they collaborated effectively with Japan, they weren't sort of under Japan in terms of the strategy for the US market. And essentially, I bought into the idea that this was a genuine commitment by them rather than just being done for appearances, and partly based on that, but also based on a few things like liking their Merpay business for the long term because they have a significant captive pool of customer cash actually held in the Mercari accounts from when they sell goods. That kind of made me turn more positive on the company, and we started pushing this more heavily at the end of September 2019. And actually, Smartkarma readers would see that both my colleague Campbell and Thomas actually commented, Thomas Schroeder commented at the time that I was probably a little bit early, and they turned out to be right. I was a little bit. I think it bottomed towards the end of 2019. And that was when we reiterated our conviction call on the company. But, given the performance of the stock since then, I think we have been vindicated in that call. But to explain where we see things going from here, in the most recent quarter, I think the most significant data point out was the performance of the US business, where Mercari actually managed to hit $100 million in monthly GMV. So this was a target that we had actually completely given up on because they had been trending at roughly half of that run rate in the quarter prior. And we had some hope that they would actually see a significant acceleration in terms of their GMV, particularly because of the various tailwinds from the coronavirus. But we didn't really expect this. We were bullish, and part of the reason we were bullish was what we mentioned before in terms of the US management team being given a free slate to kind of restructure the overall Mercari strategy, which I think is what they had been doing over the last 2 years or so. And from speaking to the company consistently, what we felt was that there were a variety of initiatives that the company had been deploying in terms of technology as well as partnerships with postal services. They had been deploying price suggestion and various user authentication methods and things like that. But all of this essentially seemed to lead to Mercari trying to complete their vision of the app that would be necessary to be successful in the US. And the timeline also seemed to be around the end of 2019 for that technical or backend to be complete. And the strategy was from that point to really drive through promotion and have an advertising blitz to really try and push the US forward and hit a tipping point to essentially prove to themselves that it was possible to replicate their success in Japan in the US as well. So that is what we were really looking forward to as the potential upside driver for the company. At the time that we said the company was a buy in late 2019, what we were saying was that essentially it was worth the stock price just for the domestic business alone, simply because the EV to sales had fallen to just barely over 2 times. So we felt relatively comfortable that even if the US was a failure, that the stock was still worth more than what it was trading for. But what we were really looking for was success in the US, which would completely change the scale of the opportunity before the company. So that we think is a complete game changer. And obviously, in terms of the potential market that the company can now address, the US probably is at least 3 times the size of Japan. But what we think is more pertinent is that we feel it will be much easier for the company to translate the successful US strategy to other developed markets, for example, the UK or other places in Europe, Australia, and even looking slightly closer to home. Even initially, when we were skeptical on the US business, we commented that the company would probably find more success if it actually tried to expand into ASEAN, where we feel that the culture is a little bit closer to that of Japan. So we still feel that that's an opportunity that's available to Mercari. And once that happens, potentially even other developing markets could be tapped, although we think the company will probably need to figure out a specific strategy to target these markets as well. So the opportunity set is truly enormous. And on top of that, in Japan, Mercari has demonstrated the ability to actually hit an operating margin of about 40%. So in terms of its long-term target, I think the company is targeting sort of high 30s or a 40% margin. We don't think that's going to be trivially simple to achieve, but we do think it's achievable. We have some insights actually doing some proper marginal profitability analysis to actually show this. And if anything, we did those analyses, I think, about a year ago. And since then, we've actually seen Mercari's operating leverage looking better than we expected in terms of the company not having to add headcount. I think headcount has been flat for about 5 quarters. And you've seen a lack of scaling in costs, even though GMV has been accelerating. So not only is the opportunity set in terms of the potential market size absolutely enormous, the company has demonstrated the ability to generate exceptional margins. And in a world where you have a lot of extremely unprofitable companies grossly exaggerating their potential TAM and still earning multiples, like 10 times EV to sales, we think it's, well, frankly absurd that Mercari is trading at under 6 times EV to sales on consensus numbers, which we feel are probably a little bit conservative. But the story doesn't really end there. What we think needs to be appreciated most about Mercari is simply the difference in the dynamics because it is C2C e-commerce. People who've been tracking the Japanese business will probably know that since Mercari started gaining momentum, every other flea market type operator has just completely been swept aside. I mean, they've been just completely unable to compete. And we think part of this is execution on Mercari's part, but we also think that part of it is just the overall structure of the market. So on the execution side, one of the reasons that I feel excited about Mercari, and I don't feel entirely stupid about making claims like this could be a 10-bagger, which is a little bit silly, I think, for an analyst to publicly declare, because you don't well, you can look very silly being wrong. But nevertheless, Mercari's management really impresses me. I think that they recognized very quickly that trying to translate the Japanese way of doing things to the US wouldn't work. And although I think a lot of other Japanese managements seem to recognize this, their response to it and sort of ability to just do what's optimal and what's effective and what will work rather than what's emotionally comfortable is, I think, extremely weak. Whereas from my discussions with Mercari, they kind of just digested that. And once that was done, they just knew what they had to do and they did it. And that's a very different attitude, I think, within Japanese management. And maybe that fact alone is what actually gives me some confidence that Mercari has the ability to compete on the global stage, which I don't think, I'm not confident saying that about any other Japanese software company. This is the only one. And I don't know if domestic investors will necessarily see it the same way, but I feel that over time they probably will, and that will make this an extremely scarce commodity of the stock. But in addition to that, I feel that Mercari's way of doing things is extremely rational, and there's a certain intelligent ruthlessness to the way they approach things and the way they think about things. And this is an attitude that I've compared to companies like GMO Payment Gateway and Kians, which are also, I think, extremely well-run companies and both quite dominant and both command extremely high multiples. I think they've been doing what they do for a lot longer than Mercari, which is why they command significant premiums over their peers. Mercari, firstly, doesn't really have domestic peers, and if you look internationally, I think they look relatively undervalued, but I think partly it's because they haven't had enough time to really show what they can do. But I do think the results in the US last quarter were the first shot across the bow. And I think if they can keep putting up numbers like that, you're going to see this start to rise very, very rapidly. The second point which I want to emphasize is the strength of C2C. And I think the difficulty of retaking or entering the C2C market when there's a dominant player, I think, is an order higher than even having a dominant position like, say, Amazon in the US. Simply because you have both sides of the transaction in terms of both a massive base of users, buyers, as well as a massive base of sellers. And for used goods in particular, most companies struggle to generate supply, not demand. And Mercari's ability to actually solve this problem is completely unmatched, in my opinion. Plus, the company is very, very focused on this and aware of this. So even over 2019, there was a brief period where the GMV growth domestically was also relatively weak. But when I spoke to the company, what they said is essentially that they are de-emphasizing GMV growth in terms of buyer promotions. And what they were really trying to figure out was how to grow supply. So that's where they were really focused on expanding their competitive advantage. And we think that the recent results, even in Japan, were quite strong in terms of GMV growth. And we think that's a reflection of some of these initiatives in terms of growing supply, which include conducting workshops for people who don't know how to sell on Mercari, and adding new services where, for example, instead of having to pack the goods that you want to deliver yourself, you can actually bundle them and send them to a service provider, and they do all the packing and the shipping for you. So they've been doing that. They've partnered up with the post office. They've partnered up with Docomo, which gives them access to Docomo's D points. And I think in terms of application usage, we actually saw recently that I think Docomo's D point app is something like the 4th most used app in Japan. So they are really cornering that market. And we think that once you have the C2C market cornered, it becomes extremely difficult for any other company to build supply. The reason being, since it's a second-hand good that you're selling, usually the exact price that you're looking to sell something for is not the most important thing. You just want to be guaranteed that you can sell it and that you can sell it in a reasonable amount of time. This is what Mercari's platform allows you to do. And they've initiated things like price suggestion and analyze a lot of data to help people actually make those decisions very effectively. So that advantage is not something that any competitor can garner very easily because it's a very, very different market from the primary markets. So we think that there's a distinct possibility that Mercari can become a monopolist in the secondary markets. Also that it'll be extremely difficult to dislodge them. But one of the reasons we feel this can be a 10-bagger, perhaps even more, is simply that once they have that position, we feel it's actually not so difficult to then start expanding into other areas. For example, once you understand how all the transactions are taking place in the second-hand markets, that information becomes extremely valuable to manufacturers. So it wouldn't be too easy to get manufacturers to list new goods on your site. And that allows purchasers to then easily resell them when they want to, which is an advantage you wouldn't have on a traditional site like Amazon or something like that. The manufacturers will be actually able to see how their goods change hands and maybe the frequency of that. And that could actually help them do things like improve product development. For example, if you refresh a product and it starts being sold on much more quickly than your previous products, that could be a hint that something's gone wrong. And that sort of information and ability to understand what customers value would be extremely valuable to manufacturers. And we feel that Mercari also has an opportunity on the data side in terms of building out a business. So they never really talked about this too much in their presentations, but we've actually been speaking to them about this for the last year and a half, and they've constantly, and what they've told us is essentially they have a team and they're looking at this very closely, but they're not looking to sort of commercialize it yet. But in their last quarter, they did have, I think, one slide talking about this. So the company does also plan ahead and sort of lay the groundwork for future growth initiatives without necessarily highlighting this in their presentations. And this is also something which we feel is a little bit similar to GMO Payment Gateway. And that's why we think there's a possibility for Mercari to really compound at an extremely high rate consistently and for a long time. And in Japan, that seems to lead to multiples rising to really ridiculous levels, as you can see with companies like M3 or GMO Payment Gateway. And so we think that kind of base case itself is very attractive. But the recent success in the US really hints at the possibility for things to really take off, because domestically, Mercari kind of hit a point where GMV just exploded. And if they can replicate this in the US, we think there's truly enormous upside for the stock. But what's important to understand is that if they do that in the US, and they can actually become the dominant flea market or C2C marketplace in the US, we feel that that actually then opens up the opportunity for them to even try and capture some of Amazon's market. And while we think there are advantages going from C to C to B to C, we don't think the reverse is true. And that opportunity is, we feel it's a really staggering opportunity. It's difficult to overstate. And being able to buy into that at a market cap of something like $7 billion, or actually slightly less, that seems like a really attractive opportunity to us. We were actually looking at Carvana this afternoon, and the market cap looks to be something like 40 billion. And we don't understand the company extremely well, but the fact of the matter is Mercari has various tie-ups with auto parts sort of fan sites, and is trying to increase sales of products like that. If the US online used car market, or the player within that, is worth $40 billion, and Mercari can capture the C2C market, we don't see any reason why it can't then expand into and take over markets like used car sales. So we feel that the company relative to others is extremely undervalued on multiples, despite the fact that management executes in a very rational and intelligent way. Even on governance, they now have a structure with three independent board members, one of who's female, versus 2 executive directors. This too is relatively rare in Japan and positive. And then on the path to profitability, they already are profitable in Japan, and fantastically so. So it's quite strange to us that you have companies trading at significantly higher multiples than Mercari when their opportunity set is probably lower. Their margins are often non-existent, and the barriers to entry are generally highly exaggerated. Whereas Mercari, through its dominance in Japan, has demonstrated that once you win in this space, it's essentially game over. So, when you put all that together with the fact that the company has significant advantages on the data side, yeah, I mean, we say it can be a 10-bagger, and that might sound silly, but while in a lot of cases, if you call a stock a potential 10-bagger, it's a bit of a shot in the dark. In this case, we feel the possibility is actually quite tangible. And given that the stock is about $6 billion, even to become a 100-bagger, that's $600 billion in market cap. I mean, that would make it the biggest company in Japan by far. But nevertheless, when you compare the opportunities with the market caps of companies like Amazon and things like that, while it's not necessarily worth thinking about a possibility like that, as we've articulated, it's not impossible for the company to actually get there. And so the share price where it's at, I think, just really materially undervalues not just the quality of the company, but the staggering levels of upside on offer. So yeah, I mean, that's why we feel this is the most attractive opportunity that we see. And in truth, this is probably the most attractive opportunity that we've ever seen in our career. So yeah, sorry, I think I rambled on quite a bit. But I hope that articulates why we feel there's so much upside to the stock. So yeah, if anybody is still hanging around and there are questions, we'd be happy to take them.
Thank you very much, Mio. Yes, it is obvious that your conviction is quite high. So we are just about out of time, but please do feel free to send in questions if you have them. And in the meantime, I want to ask you, Mio, I kind of want to flip that around a little bit and ask you, what are then the risks following these very positive results and this very high conviction of yours? Is there anything, do you think, that could throw a spanner in those works?
It's quite difficult to see. So the US is still not proven. It's not entirely impossible that a lot of the recent growth was juiced by tailwinds from COVID. We suspect that's not the case, but they'd have to post a few more quarters of strong growth before I think investors could be completely comfortable that they've really figured out the US. We have pretty strong conviction that they have, just based on our history of conversations with the company and what they've actually managed to achieve versus what they've said historically that they're trying to do. So we would take the risk of being wrong on that. We think we're pretty confident on that bet, but that's probably the most pertinent thing. There are some slight risks in terms of the Japanese payments business, but even on that end, Mercari has been willing to spend on promotions and take losses because of that, but they've never been wild about that, and they've always been quite smart in terms of trying to find the most cost-effective way to do things by partnering up with companies which don't have the know-how they do, but can give them cheap access to, say, networks of merchants, or help them acquire customers, like with Docomo or the Shinkin Trust banks. So yeah, there are some slight risks. And the other thing is, I mean, the multiple was 2 times EV a few quarters ago. So if for some reason people ended up valuing it at that level again, of course there are risks even if the company does continue to grow, but we don't think that that is at all justified, and we think that, you know, the results of the last few quarters probably will have investors reassessing. So from that perspective, probably the biggest risk we see is just the fact that we think a lot of market multiples are just extremely frothy, and particularly in the tech sector. So that has us cautious, but our frank opinion is that rather than not being long Mercari, you probably just want to short other stuff which looks genuinely bubbly.
I think that's a great point to end on. That's just about all the time we have today. So thank you, Mio, and thank you everyone for being with us today. Do note that Mio is available for bespoke research requests or premium services, so please do contact your Smartkarma account manager in this regard. And if you have any other questions, please email us at research@smartkarma.com. Thank you once again very much, Mio.
Thanks, Michael. Thanks, everyone.